Hey guys, welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm so excited that you're joining me today. Today, we're actually going to talk about K-1s, everybody's favorite subject, right? Taxes. But I want to let you know that I'm recording live from the Best Ever Conference here in Salt Lake City. So we are going to keep today's presentation pretty short because if you are here at the Best Ever Conference, I want to see you on the floor, not like behind a Zoom screen or anything like that. But if you're listening on your favorite podcast player of choice, we do this webcast live every Tuesday to help you learn how to take your active income and your savings and invest it into passive income and long-term wealth. And so we talk about all those problems that limited partners face and how to tackle them. Now, today, I am so blessed to be joined by our Director of Finance, Tao Brody. Tao, welcome to the show.
Whitney, thanks for having me. Great to
Yeah.
be here.
Yeah, Tao has been with us for the past couple years, and we do this episode like this every spring to help our limited partners understand what is this world of K-1s? Like, what kind of tax document am I getting? When am I getting it? How do I read it? But before we dive into those details, Tao, would you just take a quick, like, little 60 seconds and let people know who you are and what your role is here at passiveinvesting.com?
Absolutely, I'd love to. So, as Winnie said, my name's Tao Brody. I'm the Director of Finance for passiveinvesting.com. I've been with passiveinvesting.com since January of 2022. So now I have 4 tax years under my belt with this firm. We learn something new every year. And I know Whitney said we do this for our LPs, but a lot of our GPs tune into this too. And there's always something new that can be learned and just enhanced through the tax process. So I really find value in these webinars. Whitney, thanks so much for doing them. And I have noticed a decrease in the amount of questions we get from our investors. And I want to say thanks to you because I know you're doing so much work on this end and educating them and helping them understand how all this works because it's not the most straightforward area.
No, there are a lot of translatable skills, especially if you've done your own real estate before, invest in stocks, bonds, and mutual fund, but still we're learning a whole new language. And one of those
Mm-hmm.
new terms we learn, especially when we transition into this world of passive real estate, is K-1. Okay. Most people before they've gotten their W-2, their 1099s, maybe like a 1099-R, but they've never gotten a K-1. So let's kick it off there. What is a K-1? Why should a limited partner care about the K-1? And then how do we read it?
Yeah, great question. So, Winnie, I did prepare a little presentation. I'd love to pull that up on the screen if that's okay with you.
Let's do
Um,
it.
let's do it. Okay, before I get started, just the standard disclosures. I'm not a tax specialist. I am a CPA. I have a lot of experience with taxes, but this is just meant to be an introductory session to enhance everyone's understanding of a Schedule K-1. The IRS rules are and the guidance are constantly changing, so could change this year, could change next year. Who's to say? And always consult with a professional for your own tax strategy and advice. Again, today's session is not meant to be advice. It's just helping you understand how to navigate around your Schedule K-1 and the business. So I know you asked me a question, but I'm just going to kick it off with the way that I have this presentation set up. So due dates, most of you viewing today might be filing the individual return. So Form 1040, that due date's April 15th. Partnerships, also invested in a lot of real estate partnerships. That due date is March 17th because the 15th falls on the weekend. And as always, you have the option to extend 6 months. So I've included the extended deadlines there. So what is a K-1? What's the purpose of a Schedule K-1? All partnerships are required to file an entity level tax return, which is known as Form 1065. Real estate partnerships are passed through entities, meaning all of the income, all of the expenses, losses, credits, so on and so forth, are passed through to the individual partners of that partnership. So ultimately, when a partnership files these tax returns, there's no tax due at the partnership level. there are caveats. There might be a withholding tax or state tax or something that's paid by the partnership. But in general, everything is passed through to the partner, and that partner will ultimately receive the benefit of the losses or pay that income tax. Of course, the amount of loss that you can claim on your tax return may be less than the amount reported on your K-1, and it is the partner's responsibility to consider all of those applicable limitations. So who files a K-1? It can be LPs, GPs. Basically, the answer is everyone files a K-1 if you're a member of a partnership. It's the entity that's invested and holds interest in the partnership. So that might be an LLC, another partnership, an S Corp, estate or trust, or you could just be invested in the partnership as an individual. Before I go on to my presentation, Whitney, do you want to pause there and ask any more questions?
No, I think we're good. I mean, guys, if you have questions, we will field as many as we can in the time that we have today, which is a little bit shorter, but make sure you find your Q&A box in your chat box, Tao. I will monitor that for you.
Okay, thank you. Also, Whitney, just something to note, we're not answering any personal tax strategy questions today. This, again, is just meant to be educational. Okay, I just want to give everyone a kind of timeline on how tax prep goes from our perspective so that you are aware of how it goes from your perspective and also when you can expect to receive a K-1. So typically as we get closer to the end of the year, around Q3 or Q4, we start doing touch points with our tax teams. PassiveInvesting.com uses 3 different tax firms. We found that it's easier to keep some of our segments differentiated, and also it helps us expedite that K-1 delivery timeline. So around Q4, we'll do our touch points. We'll say, here's our activity for the year. Here are the new entities we've added or disposed of. Do you have the capacity to take on this new portfolio or enhanced state of work? At that point, we'll sign the engagement letters, and then we'll start delivering all the investor rosters, the formation documents and operating agreements for any new entities, and basically front load as much as we can before the end of the year, which is basically delivering everything except for the year-end financial statements. That way we can hit the ground running once January begins. Once January starts, that's when the tax team starts importing all those rosters, validating all the information, making sure there's no changes from prior year. If there are, making sure they are fed through into their system properly. And then our goal is always to get the tax teams the financials by the 2nd or 3rd week of January. Oftentimes we see the K-1 delivery be later than we would expect it to be, not from our perspective, but from what we've heard from investors, is that operators and syndicators are getting those financial statements over to the tax teams too late. There's like a sweet spot in January where the tax teams aren't quite busy yet. So if we can get everything to them in January, they're typically able to give us some preferential treatment and get us started and in the queue above anyone who might be sending financials in February and March. So that's our goal every year. February is typically when we start getting the drafts back. We address any tax team questions and review them until all of our discrepancies and questions are ultimately resolved. Then March, we start delivery. So we've already delivered almost 30 partnerships K-1s as of this week. In March, I expect that we'll be able to deliver all of them by the end of March, although the goal is always to get them out in the next week or two. So just finalizing some last questions and discrepancies so we can finalize those. So that's our timeline. Whitney, is there anything that you feel I've missed or that you want to go through?
No, okay. Let's move on.
Okay. Now I just want to go through a K-1. This is your boilerplate K-1 directly from the IRS. You can Google it. You can pull it from the IRS website. They update it each year. So you'll see at the top, it says 2024. And they might tweak it. They might change it. I don't think anything significant changed from 2023 to 2024, but we'll go through each of the key sections so that you'll gain exposure and get familiar with it. So starting out with part 1, this is the information about the partnership. And the reason why I want to bring attention to this is given, like, for example, we're issuing over 6,000 K1s to investors. We have a bunch of controls in place to make sure everything's reconciled and no issues arise, but there's always a risk of data migration issues from our team to our tax team, whereby a partner might be added to the wrong partnership. So step one, when you receive a K1, did you go dark on us, Whitney?
I did. I'm gonna go. I guess I sat still long enough. The lights turned out. Keep on going, guys.
So step one is make sure that you are familiar with the partnership you're receiving the K1 for, and that you're actually an investor. If you receive a K1 and you don't know the partnership name, reach out to that syndicator, the tax firm that you received that from immediately. And maybe it's just that you knew it by the street name and the K1's in the actual LLC entity name. Just have that understanding. That's step one. Part two is the information about the partner. This is your section. This is the partner's section that they are responsible for. So you need to be confirming all the information in this section, from the tax ID number all the way to the type of the entity. So here I've listed what we've seen the most common issues to be, just so that you can look out for them and hopefully address them before tax returns are filed. So first is the incorrect tax ID might be used. So maybe you confused your partnership with another single member LLC and you've provided the wrong EIN number, or maybe you didn't realize you used your wife's social security number instead of yours, and it could be so on and so forth. Just make sure that number is right. Check every digit. Sometimes there's just a miskeyed and their digits got reversed. The next is incorrect name or address. Simple fix. Usually if these corrections come to us after the fact, like after we've delivered your K1, we might say, well, hold off, we'll make those changes next year. They're not going to have any impact on your tax liability, as long as your tax ID number is correct and the actual information on the K1 is correct. Next would be any if you're invested through a custodian, like an IRA or whatnot, you might be missing the custodian's name or not using the custodian's EIN number. So always check it with your custodian before you make these investments. They are familiar with them. They know what the syndicators need and what you need to present in your PPM. Next is a domestic partner with a foreign address. If we're tagging you or classifying you as a domestic partner, we expect you to have a domestic address. So that just might be a area where we reach out and reconfirm what is your domestic address. The next area, this has been a layer of confusion for the last few years, but I feel like investors are finally understanding of a single member LLC and how that's a disregarded entity and why. Because just like a real estate partnership, a single member LLC, everything passes through to the ultimate beneficial owners. So it's imperative that we have the information for that ultimate beneficial owner of the single member LLC presented in the K1 as required by the IRS. So not only are you providing the EIN number and the entity that's invested, which is the single member LLC, but you're also providing the UBO's name and tax ID number, whether that's an individual or it could be a partnership, and you're providing the partnership name and the EIN number. And then lastly, just if you are invested through a retirement plan, double check and make sure that that last section in I-2 is checked, because that classifies you as a retirement plan. Any questions there, Whitney, before I move on?
No questions.
I'm glad to see you brought the light back.
I did. Hopefully, I continue to move my arm. Hopefully it won't go down on me again.
Next up is the partner's share of profit, loss, and capital. Again, this is based on the partnership agreement. It's typically consistent year over year. There are exceptions, such as if there were any contributions or redemptions during the year, that would obviously have an impact on your profit, loss, and capital percentages as compared to the total equity amounts. Maybe a partner assigned their interest to another partner and left the partnership. Also in the year of disposition, you're no longer going to have an equity stake. So there are different manners of presentation here. For example, some years or some tax firms may present, like in year one, beginning balance may show as zero. It may just show as what the entity opened as. So different styles. One's not necessarily more correct than the other. Just make sure you have an understanding of what's presented there. And if you have questions, just ask. The next section is the partner share of liabilities. This reports the partner's individual share of the partnership's liabilities. There's three types: non-recourse, qualified non-recourse, and recourse. If you have a negative balance, this section will be used to determine your basis. Otherwise, typically you could ignore this section. It just depends on the nature of the loan. If it's non-recourse, you'll probably see an amount in your beginning and ending balances, whereas if it is a recourse loan, the guarantor will be allocated all of that liability. Yeah. Next is the probably most used section of the K-1. This is the partner's capital account analysis. This is the section that I say every year it's critical that you understand and you track it. And I've actually put together an example in the next slide because I always go through this verbally, but I think that is one of the questions we get the most on when we take a investment full cycle. For example, oftentimes investors don't understand that you need to view the investment from inception to date. You can't just look at that last K-1 and understand how the investment did. You have to see it from inception to the year it was disposed of. So this section starts with your beginning capital account balance, so that in year one of the investment or acquisition will always be zero. Then any capital you contributed will go in the next line, which is just any investment you made during that year. Then any partner share of the current year net income or loss, any withdrawals and distributions, which would be distributions paid out during the year or redemptions of capital. And then typically for these real estate deals, partners will see losses in the first few years. That directly decreases their capital balances. These are just tax losses driven by bonus depreciation primarily. Of course, there could be actual losses included in there, but right now, even though the bonus depreciation is sunsetting, they are driving a substantial amount of losses. And just because you see a loss in your capital account analysis isn't a direct reflection that the investment's doing poorly. If anything, investors like to see those losses because they can use those losses to offset passive income for other deals. Again, if you're using a CPA or doing this on your own, track those losses on Form 8582. You can carry them forward even if you can't use them in the current year, and you'll want to carry them forward because eventually the goal for every investment is that it will go full cycle, and ideally we'll have some income that you'll be able to use these losses to offset. So as I started in saying, it is the partner's responsibility to keep track of those losses and help use it so that you can use those losses to offset income in future years. Okay, so the example, this is just a very basic example. I just wanted to give you some direction on how you can do this tracking on your own in Excel and how easy it can be. So I use an example of, okay, we held this asset for 4 years. We acquired it in 2021. This was before bonus depreciation started sunsetting. So I'm saying, okay, you invested $100,000 of capital in 2021 in this real estate deal. You essentially were allocated $50,000 in losses, primarily again driven by bonus depreciation. So your ending capital balance for 2021, I forgot to say, you received distributions of $8,000. So your ending capital balance for 2021 was $42,000. Okay, so take that, record it. Each year you get your K-1, you can continue adding to that. So 2022 rolls forward. First check is you can make sure your ending capital balance from the prior year is your beginning capital balance for the current year. That should always be the case. sometimes issues occur in tax systems, or maybe the syndicator changed tax firms and there was a data issue. So step one, check that. So just going through this, overall, the net income allocated to this partner would be the 50,000, the 15,000 in 2022, the 5,000 in 2023, and the 1,000 in 2024. So $71,000 of net income was allocated to this partner. Again, that shouldn't be a point of contention. This is actually a benefit that the partner is receiving, these losses that they can either apply to this same investment when it goes full cycle, or that could be applied to other passive income for other investments. So that was essentially a benefit that the partner received, in addition to the $8,000 of distributions that they received in years 2021, 2022, and 2023 of 24,000. So in total, that 71,000 of losses, the $24,000 of distributions is $95,000 of gain. So if you were to look at the 2024 K-1 and see that gain, you would ultimately say, like, how did I have that much gain? So it's vital that you look at all 4 years. So again, I did not set this up well in my articulation of this, but in 2024, I'm showing that the investor received $100,000 back. So ultimately, they invested $100,000, they received $8,000 a year in distributions, and then in 2024, they basically just received their capital back. There were no proceeds on the sale or anything. So in the end, the overall gain for the life of this investment, as you can see by looking at all 4 years of these K-1s, was $24,000, which effectively is just the $8,000 per year that they received in distributions. The net cash distributed was that $8,000 as well, but that can be also evidenced in the cells I highlighted blue. So the $100,000 that was initially invested, the $8,000 received annually, and then the $100,000 of capital that was returned in 2024. Another area of this that I feel we've received the most questions is, again, they're looking at 2024 K-1. They look at the gain and they don't understand that box 10 includes the overall gain. So I've included this disclosure here, is box 9C is a disclosure only section on the K-1, and it's disclosed separately just because it's taxed at a different rate. So we might get in questions that are like, well, I have this gain in box 10, I have this gain in 9C. Why am I showing so much gain? And it's the answer, in short, is that the overall gain is included in box 10, but your tax CPA will know what to do and why it's presented differently and how that impacts you. Whitney, anything that I could expand better upon here?
No, I think it's great. We're getting some questions in the chat on if this session's being recorded. Yes, it is. Will it be shared? If you're registered, you will always get an email of these sessions. And as always, they are posted on our YouTube page. But Tao, thank you so much for sharing this. I think this really connects the dots for our investors to help them understand just kind of the life cycle of their capital contributed, the cash flow that comes in, and just really how to track that. Thank you so much for sharing.
Yeah, of course. And we're always here. I have built this out for investors at times when they ask for it, but I feel it's so simple for an investor to be able to just put this in an Excel document, track their investments, and have that control over the whole life cycle on their own. So here it is. Here's the format I would use. And I hope that at least some of you take this away and use it for your own investment management. Okay, next is just different areas of part 3 that are primarily used for a real estate investment. Whitney, if there's anything else you want to talk about in this section, I'm happy to do it, but these are the ones that you'll typically see used. So part 3, box 2, is the net rental real estate income. Multifamily rental income is always reported in this box. It's generally passive income or loss for all partners, unless the partner is a real estate professional. I've included how you become a real estate professional in this section here if you want to read more about it. The difference here between a real estate partnership versus maybe like more of an operating partnership is evidenced in box 1 versus box 2. So our multifamily deals, the rental income would be classified to box 2, whereas our car wash deals, because there's no aspect of rental income, it's just day-to-day operations and it's just ordinary business. So that would be classified to box 1. That being said, the investors who participate in our car wash deals are still passive limited partners. So that will still be a passive income or loss number, although it's not included in box 1 for the car wash investors. Questions there?
No, I think this does bring up a question that we had somebody ask earlier. For the investors that are in our rehab or our Pick That Fund 1 that invests into the rehab wallet hard money lending arm, are they receiving a K-1? And 2, if so, how is the income noted?
So all of our debt funds, all the K-1s for all of our debt funds were issued, I believe, on Friday. So they should all be posted. If you haven't received a notification, reach out to Investor Services team. They were the first ones completed this year. That income allocated for the debt fund will just be the interest that you received or the pref that you received on your investment. There's no additional allocation of ordinary income or rental. There's no other allocations of income for the debt fund. It is just you earn 6%, you earn 8%. That's what your income is showing on your K-1. Okay, so next question here, or next topic is how is the net rental real estate income calculated? What is it based on? How did it get in your K-1? So we went through the profit loss percentages earlier and where that's disclosed on your K-1. That percentage is applied to the net income or loss that's calculated in the partnership's return. For these rental real estate properties or partnerships, the primary calculation for this is on Form 8825. I've included a snippet here for reference, but that's where we include all the gross rents, less all of the real estate expenses, inclusive of depreciation and interest. This will then feed into Form 1065 and be netted against any other types of income or loss, such as ordinary income, interest income, gains, losses. So that number, net of all the other types of income, is multiplied by your P&L percentage to get what numbers are then essentially fed down into your K-1. So partners are taxed on the net income of the partnership, regardless of whether that net income is actually physically distributed to you. Next, we're going to go through distributions. Frequently, partnership agreements include a distribution which involves a preferred return on or of the capital invested by the partner. For tax purposes, to the extent an investor has tax bases, so think back to the capital account summary we just went through. If that number is positive, then let me say inclusive of the investor's share of liabilities as well. But if that number is positive, with the liability portion included, distributions are a return of capital and not taxable. So that distribution, the example we went through earlier of like the investors receiving $8,000 annually in distributions, that number would decrease. Here, let me just go back.
It would decrease the capital account.
It would decrease the capital account balance. And if you see the ending capital account balance here is positive still, that is not a taxable distribution. When it goes negative, and after you've included the partner's share of liabilities, that at that point, the distribution can become taxable to the investor. Typically or usually these distributions are calculated just by taking the partner's unreturned capital balance, multiplying it by the distribution, the cash on cash distribution. It could vary by investment class. So just be aware of when you invest in a partnership, there might be class A, B, C, or whatever they decide to call it, that will have a different type of cash on cash preferred return or so on and so forth. Some might be accruing interest, whereas others might be paying it out, might be based on net cash available. Just make sure you're aware of that when you're signing those PPMs. Ultimately, two types of distributions. You have the capital distribution, which is just decreasing the partner's capital account balance, which we just discussed. And then we have your liquidating distribution, which will ultimately zero out the capital account and any equity interest in the partnership. Other information, this is just where basically any other types of deductions or limitations might be included. There's a code for each of them. I've listed out the primary ones here, but I don't think it's necessary for us to go through each one. This is a section that would be beneficial for you to consult your CPA to make sure that you are considering your limitations on any losses and deductions properly. Just some reminders as you review your K-1. If it's a liquidation year, as in we've disposed of the property, this is the last year you'll receive any allocation of income or losses, that final K-1 box should be checked. We still have to include forms K2 and K3. It's a lot of extra pages. It's a requirement. It's designed to provide greater clarity to partners on how to compute their U.S. income tax liability with respect to items of international tax relevance. Even if we don't have any international tax components, it's still a required form. Bonus depreciation rules are still sunsetting for the time being through 2026. I think we're all well aware of this by now, but it was 80% in 2023. For 2024, it's 60, and so on and so forth. Tax Relief for American Families and Workers Act of 2024 included proposed changes for a 100% bonus depreciation deduction for qualified property placed in service after 2022 and before 2026. And then, as always, just be aware of state compliance pertaining to K-1 filing requirements and treatment of bonus depreciation. Some states have limitations. Our tax team does a great job of monitoring all of them, but it's something that you should be aware of. And also you should be aware of when you sign those PPMs of just making sure you know which states you could be required to file in. In summary, unless you want to go through anything else, Whitney.
We have some questions in the Q&A box, but we usually do our Ask Me Anything part of the show. So let's go through the summary.
Okay, so in summary, verify your personal information is appropriately captured in your investor portal. Simple check. We usually send an email out in November or December timeframe that's like, hey, we're going to be pulling the investor rosters on this date. You have 2 weeks or a month to review your personal information and process any changes now. But if you do notice something is incorrect on your K-1s for 2024, go into your portal now and make sure it's updated so it's not going to be rolled forward incorrectly in 2025. Understand the tax prep and tax filing timeline. We went through this. All K-1s for passiveinvesting.com and our portfolio of entities should be posted by the end of the month, most of which, or half of them at least, have been posted as of today. Something I did not note is we typically give our investors 2 weeks to a month to review their K-1s after we deliver them to propose any changes or ask questions. Our tax team often says this is too kind of us to allow this long of a review timeline, but we want you to have a correct K-1. We want you to have the information to be accurate. So it will help if you review those timely once they're posted and get back to us as soon as possible. Consider any assignments of interest that occurred during the year. Different partnerships may treat this differently, but typically if you were to reassign the interest during the year, you're going to receive 2 K-1s, one for the time being where the interest was held in the transferor, and then the second K-1 for which the entity that now holds the interest. So just keep that in mind and make sure it aligns with what your intention was. And then report income losses on your tax return. So I really already said this, but the key here is to keep track of your losses to ensure you are carrying them forward and utilizing them to offset income in future years. That's the biggest takeaway in that section. So that's all from me in the presentation I prepared, but happy to hear what questions are lining up.
Well, Tao, thank you so much for your time, knowledge, and expertise and sharing all of that with us here today. Guys, if you're here live, don't go anywhere. We are going to spend just a few minutes, doing an Ask Me Anything part of our show.